Welcome to Cognitive Dose. We are here, as always, curing blind spots and shattering cognitive bias. Imagine someone hands you a 30-year-old map that promises unimaginable wealth.
Okay.
Do you just follow it blindly, or do you stop to ask if the landscape itself has completely changed? For decades now, Jack Schwager's 1989 book, Market Wizards, Interviews with Top Traders, has basically been the absolute holy grail of financial speculation.
Oh, easily. It's on every finance pro's bookshelf.
Right, exactly. And it promises that extraordinary market-beating returns are achievable for anyone provided they can master their own psychology and apply just draconian risk management. But what if those so-called wizards were really just the lucky winners of a massive statistical coin-flipping contest?
Yeah, it's like when archaeologists uncover an ancient temple, right? You look at the massive stone columns and you naturally think, wow, these people had the universe figured out.
Yeah, exactly.
But if you dig deeper, you realize the foundation was built on a fault line. And they were really just lucky an earthquake didn't hit while they were stacking the stones.
Which brings us to our central question today. Does Market Wizards actually distill the immutable, replicable psychological principles required for financial mastery? Because I will be arguing that it does. I think the text provides really profound, timeless insights into the psychological fortitude necessary to survive in any highly stochastic environment.
And I will be taking the position that the book is an epistemological crisis masquerading as a how-to guide. It completely misattributes the statistical inevitability of extreme luck to proprietary skill, and it promotes archaic strategies that guarantee the rapid extraction of retail capital in today's algorithmic markets.
Okay, well, let's start by laying out the foundation of the book's actual premise, because I think the core value of Market Wizards does not lie in specific mechanical formulas.
Go on.
When you read these interviews, the common denominator is not, a secret moving average crossover or a magical chart pattern. It is a universal, almost fanatical emphasis on capital preservation. Take Michael Marcus, for example.
Right.
The man famously turned a $30,000 account into $80 million. He multiplied a company account 2,500-fold over a decade. And his golden rule? Never risk more than 5% of your money on a single idea.
Which sounds incredibly prudent on paper.
Sure, it's more than prudent. It defies standard academic finance. The efficient market hypothesis assumes prices always reflect all known information perfectly, right? Meaning nobody can consistently beat the market.
Allegedly.
Right, but the wizards exploit the fact that markets are driven by human emotion. Fear and greed cause prices to wildly overshoot fair value. Bruce Kovner's mantra in the book is simply to undertrade, undertrade, undertrade. By maintaining superior emotional detachment, these traders systematically exploit the irrational mistakes of...
I have to stop you right there. Systematic exploitation? No. If we view this through the unforgiving lens of quantitative finance and probability theory, the book's entire methodology is scientifically null and void.
Null and void? That's a bit extreme.
It is a textbook manifestation of the narrative fallacy combined with profound survivorship bias. Schwager is selecting purely on the dependent variable. He only interviewed the winners.
But those winners had track records that span decades, You can't just dismiss that as luck.
You absolutely can, and the math literally demands that we do. Nassim Nicholas Taleb articulates this exact critique perfectly. Let's just look at the sheer scale of global market participants.
Okay.
When you have millions of people trading, the law of large numbers guarantees that some traders will experience multi-year winning streaks purely by random chance. Imagine a massive coin-flipping tournament with 1 million people. By pure statistical mechanics, a handful of people will flip heads 10 times in a row.
Right, the classic monkey at a typewriter scenario.
Exactly. But here is the danger, right? If a journalist interviews the guy who just flipped 10 heads in a row, the winner is not going to say it was luck. Human beings hate randomness.
Sure, we look for patterns.
So the winner retroactively invents a highly complex, seemingly logical justification for their success. They'll say it was their specific morning routine, their rigorous discipline, or an intuitive feel for the coin. Market wizards completely masks the invisible cemetery of millions of failed traders who followed the exact same rules, drew the exact same chart patterns, maintained the exact same discipline, but were completely wiped out.
But they didn't flip a symmetrical coin. That analogy falls apart when you look at how they actually traded. If their success was merely lucky flips, their methodologies would lack any coherent internal logic. But they all describe highly asymmetric risk profiles.
I'm not buying it.
I mean, they cut losses immediately at 1%, but let profits run to 20%. That is not flipping a fair coin. That is structurally loading the dice in your favor. They explicitly created asymmetrical odds.
That sounds compelling as a narrative, but let's look at the actual empirical reality. We have the benefit of post-publication history to test this infallible edge. If their psychological frameworks were truly replicable, they should have maintained their structural outperformance.
Many of them did.
The historical autopsies are devastating. Look at Richard Dennis. He is arguably the most celebrated example in the book. He explicitly claimed his edge was a replicable mechanical trend-following system, the famous turtle trader experiment.
Right, a legendary experiment.
But what happened in the highly volatile markets of 1987 and 1988? He suffered catastrophic losses that decimated his public funds.
Hold on, let me push back on that. Why did Richard Dennis lose that money?
Because his simplistic mechanical system couldn't handle the volatility of a shifting market regime.
No, the historical record shows he lost it because he stopped following his own rules. He abandoned his mechanical system for ego-driven discretionary bets.
Oh, come on.
He really did. He held on to losing positions based on hope. You are pointing to his post-publication failure as proof that the book's premise is flawed, but I actually look at Dennis's blow-up and see the exact opposite. It proves the thesis.
How does a catastrophic multi-million-dollar blow-up prove the thesis of a book about market mastery?
Let's use a chess analogy. If a chess grandmaster occasionally blunders under extreme tournament pressure and loses, does that invalidate their overarching strategic brilliance? No. The moment a trader abandons their strict risk parameters, the market destroys them. The edge exists, but human fallibility remains constant.
Okay, but what about Victor Sperandeo? Another wizard who preached strict 3-to-1 risk-to-reward parameters. He suffered a catastrophic collapse during the 1998 Russian sovereign debt default. He didn't just casually break a rule. He was operating with reckless 25-to-1 leverage.
Which, again, violates the very principles of capital preservation he talked about.
But it exposes the mechanical flaw in the psychology argument entirely. A stop-loss order is mathematically irrelevant when a market gaps down in a zero liquidity environment.
Well, liquidity gaps are rare.
If you tell your broker to sell if the price hits $10, but the market suddenly crashes and there is literally no one willing to buy until the price hits $2, your psychological discipline is useless. The market just skips your price and you are wiped out. Their historical returns weren't sustainable alpha. They were the direct mathematical result of taking on massive, hidden tail risks through extreme leverage.
I'll grant that leverage makes fools of us all when liquidity dries up, but you're arguing the strategies themselves are structurally flawed today.
Completely obsolete. The methodologies championed in this book suffer from severe regime dependency. They are hyper-tailored to the anomalous market microstructure of the 1980s.
You're talking about the inflationary commodity booms?
Yes, we had extreme double-digit inflation. Simply buying and holding inflation-sensitive assets with massive margin leverage generated wizard-like returns. Furthermore, these guys were trading in chaotic physical pits using hand signals.
True, the pits are gone.
Information dissemination was incredibly slow and asymmetrical. Discretionary chart reading, simple trendline breaks, intuitive momentum tactics, these worked because very few people were using them.
But the physical pits being gone doesn't render the underlying psychology of trading obsolete.
It absolutely does, when the psychology is tied to heuristics that are now actively hunted. If you're listening to this and you've ever tried to day trade, you know exactly what I'm talking about. Today,
Financial markets are utterly dominated by HFT algorithms.
High-frequency trading?
Yes. We're talking about machine learning algorithms executing global arbitrage in microseconds. If a modern retail trader tries to apply the simplistic support and resistance zones praised in the book, they are walking into a trap.
Let's clarify what that actually means for the listener. How does an HFT algorithm actively hurt a retail trader using these tactics?
Let's say you read the book and you put a tight stop loss just below a classic, obvious support line on a stock chart. You think you are practicing good risk management, right?
Right, following the rules.
You aren't protected. You are putting blood in the water. High-frequency algorithms literally see where those clusters of retail panic sell orders sit in the order book. The algorithms will intentionally short the market just enough to trigger those automatic retail sales, buy up your dumped assets at an engineered discount, and ride the price back up. It is engineered liquidity extraction.
That is a terrifying reality of modern market mechanics. I won't deny that. But I think you're underestimating the self-awareness within the text itself. Even back in 1989, Michael Marcus explicitly noted that the era of trend following was over.
He noted it, but the book still sells the dream.
But Schwager's much later books, like Hedge Fund Market Wizards, pivot entirely towards systematic quantitative programmers. This proves that the core lesson isn't the specific 1980s chart pattern. The lesson is the methodology of rigorous adaptation and risk control.
No, because the fact that these technical strategies no longer work leads us to a much darker problem, which is the most insidious legacy of the original text. It birthed a predatory, multi-billion-dollar trading education industry based entirely on retail gaslighting.
Gaslighting. That is a very heavy charge to lay at the feet of an interview collection. How exactly is it gaslighting?
Because it popularized the dangerous fantasy that undercapitalized individuals operating from their home offices with delayed data feeds can routinely extract consistent income from apex predator arenas if they just have the right mindset.
Well, mindset is important.
The modern financial market is a ruthlessly optimized wealth transfer mechanism. It is explicitly designed to move capital from uninformed retail participants to technologically superior institutional firms. But the market wizard's narrative frames trading almost entirely as a solitary psychological battle against one's own internal demons.
But emotional regulation is the prerequisite for avoiding immediate ruin. If you panic sell every dip, you will go bankrupt regardless of the market structure.
Yes, but the education industry presents psychology as the sufficient condition for generating profit. And here is the victim blaming. When a retail trader inevitably loses their capital because they are structurally disadvantaged by algorithmic latency arbitrage, the education industry uses Schwager's framework to absolve itself.
I mean, they do say discipline is key.
They tell the retail trader, your strategy didn't fail because it's mathematically non-predictive. You failed because you lacked discipline. You allowed fear and greed to override your logic. It shifts the locus of failure entirely onto the personal psychology of the individual. It normalizes degenerate gambling under the sanitized guise of paying market tuition.
Can we honestly blame the source material for the sins of its derivatives? Schwager didn't write a manual on how to scam retail investors on YouTube. And if you actually read the text, it brutally demystifies the market. Marty Schwartz explicitly states, "To hell with my ego, making money is more important."
But if the edge isn't there, the ego doesn't matter.
Let me finish this point, because it's crucial. Gambling is throwing money on black and hoping. The wizards calculate risk to reward down to the decimal. The book explicitly warns against overtrading. It warns against trading without a mathematically defined edge.
But the defined edge they claim to possess is largely an illusion masked by macro trends. The book tells the reader, look at these men. They conquered the market by conquering themselves. It completely ignores that the edge was often just being on the right side of a massive macroeconomic wave while holding massive margin leverage.
But
psychology doesn't fix a negative expected value. When retail traders try to emulate that courage today, they aren't conquering themselves, they are walking into a meat grinder. The psychological fortitude required to hold a winning trade is entirely irrelevant if the technical strategy you are using is mathematically designed to slowly bleed your account dry.
Okay,
But as we wrap this up, the human variables of fear, greed, and the necessity for risk management remain entirely timeless. It teaches that the market is a mirror reflecting your own flaws, and until you master your own discipline, no algorithm in the world will save you.
No, that is exactly the victim-blaming trap I am talking about. Treating this book as an actionable blueprint today is mathematically dangerous.
I mean, I don't know how you can just dismiss the psychological.
Because psychology doesn't fix a rigged game. You are sending people into a structurally rigged meat grinder, armed with a 30-year-old historical novel. The psychological discipline you are praising is deeply, tragically insufficient when your competitors are machine learning models executing statistical arbitrage in microseconds. There is no silver lining here. The premise is fundamentally broken.
Well, I guess the structural disadvantages are significant.
They are insurmountable with these archaic methods. Listeners, use this knowledge to build your mental immunity against these financial fairy tales. Subscribe to Cognitive Dose.